Hello and welcome back. You're watching ET Now. The show's Market at Lunch with me, Siddharth Bhamre, and my co-anchor, Nayanthara Rai. Let's talk some fundamentals now. We welcome Dhananjay Sinha, Head Institutional Research and Economist from Emkay Global. Hi Dhananjay, welcome to ET Now. Now 2017 has been a year which marked as, a very rare year where we didn't see any kind of correction. Even if they were to the tune of 2 to 3%, they were very shallow and short-lived. And the market continuously moved up, and this happened despite FIs were not participating, but DI's money was substantially up. But we have started 2018 on a roller coaster ride. Jan was pretty okay. Feb was the worst series which we saw since last 2 years. I understand that volatility helps identify or your favorite stocks. You get your favorite stocks at lesser valuation. But how to deal with this volatility and how to position your portfolio in such kind of markets?
So the thing is that we are cognizant of the fact that there has been a considerable amount of flow as far as mutual funds are concerned. So we have seen post demonetization and also after the GST, the upsurge in the monthly flows of mutual funds have been pretty high, largely dedicated into equity markets and equity stocks. And we've seen a significant upsurge in the valuation, especially for the mid-cap index or in mid-cap stocks. Mid-cap index actually went up to almost like 56 times on a trailing basis versus 25 times for the benchmark indices. So there has been a considerable amount of a flow that has happened. Our assessment has been over the last one and a half years. We believe that the market has actually, or the flows in mutual funds have been triggered by the performance of the market itself. So there is a virtuous cycle that was happening. So our view has been that mutual fund flows are subject to market vagaries. So if there is a situation of increase in volatility, it is likely that the flows into mutual fund will start tapering, and possibly at some point of time, if the correction sustains, there might be some redemptions as well. So I think that is a scenario that we are looking at in 2018. So I think the volatility is going to be high. What has also happened is that the excess liquidity in the banking system has dissipated. The short-term rates have gone up. So I think there is a lead indicator for what could happen to the liquidity that has flown into the equity market or retail participation, or even some of the business money, idle money that has been with the business sector that has actually flown into the market. So I think that correction, that outflow can happen. So I think the volatility is definitely going to be there. So the position, to answer your question, how to position ourselves, the way we are looking at is that if there are stocks which have actually gone up, let's say by 50-60% or more in the last 1 year, and let's say last 1 year's contribution in the overall rally of the last 4 years is, let's say, more than 50%. That's where we think that there will be more more correction, and we are sort of trying to position ourselves in stocks where there are lesser overweight position as far as
Right. So I understand, it's not a very promising, 2018 which you are looking forward to, and maybe, some outflows would happen. But let's get down to sectors and, banking and financials. Now, that's where, I have not done any research on that, but I'm sure more than 90% of funds, be it global or domestic, have overweight stance on banking and financials. Do you think that stance should change in view of what's happening to PSU banks, what's happening in private sector banks where credit offtake is not so very great at this point of time, though HDFC Bank in its quarterly numbers did say that after 6 quarters they have seen some uptake. But if liquidity has to move out, it will move out from where it is overweight, and that's banking. How are you positioning yourself, your clients, and your advice to different funds when it comes to banking and financial space?
Yes, you're right. Actually, a large part of delta as far as price performance is concerned came from the banking sector, especially the PSU banks. So I think what had happened is that because of the recapitalization announcement of 2.11 trillion by the government, I think the PSU banking stocks went up quite significantly. Some stocks actually doubled, post that announcement. The thing is that where we believe that there will be certain retrenchment out there, because we believe that the PSU banks will continue to lag in terms of credit growth, wherein we are looking at a systemic credit growth in the region of 12 to 13% this year and 13 to 15% following year. We think that it will be largely dominated by the private sector banks. Private lenders will gain that. We believe that also that with the stricter norms for recognizing restructured asset, restructured loans, I think the credit cost will be higher, again going to be a burden for the public sector banks. And all the news with respect to the scams that are happening and the contingent liability flowing into the bad assets, or certain charge on the capital, I think that reinforces that view. And the third thing is that you have steepening of the yield curve that has happened. So the 10-year has actually moved from 640% on GSEC curve.
Interject
To
there. Hi,
almost
Dhananjay. This
like
is Nayantara. Sorry to interject there. I think all of us, especially our viewers, are quite familiar with all the problems that are plaguing the banking sector, be it the yields or the credit offtake or the Punjab National Bank fraud case, now OBC, perhaps more skeletons are to be coming out. But if I could interject you there and say, given all of this that we are aware of, how should one actually approach the public sector banks? Should they liquidate their positioning? Is it a good time to, maybe accumulate at a later stage? What is the strategy that you are advising your clients?
So the way we are looking at is that in the next 5 years, the private sector banks, the market share is going to be significantly higher than what we are seeing today. So from a level of 73%, the public sector banks have actually given off the business to almost like 65 now. I would say in the next 3 to 5 years, it will go down to almost like 50%. So larger portion of the market share will largely go to the private lenders. You have the prominent lenders that you see, they are far ahead in terms of growth capital, and they have raised money recently. So we are advising people to, and we have been advising people to stay away from PSU banks. Even if you have it, if there is any intermittent rallies, I would use that as an opportunity to move into private lenders. There are value stocks even in the corporate lenders. There are certain regional banks who are growing, who are becoming pan-India banks, where we think there are value opportunities. So I think that's what we are advising people. And also with respect to the I think the whole BFSI space is actually increasing in volume with again private lenders within NBFCs, microfinance lenders, etc., emerging as the public sector banks is actually relinquishing the market share. So I think there are a whole host of opportunities there as well. Within the NBFC space, we believe that there will be a time when there will be reasonable valuations that will emerge. I think what is relevant for NBFC space is the fact that cost of fund will actually go up with the hardening of the short-term rates and hardening on the yields. But at some point of time, there will be value that will emerge even in the NBFC space.
Okay, so you just don't see the value now, but that value is going to emerge. There are about 9,000 entities which have also come under the scanner for irregularities when we talk about the NBFCs. Thanks a lot for joining us on the channel and joining us and telling us what you make of all of these important sectors like banking.